Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're looking at Viatris Inc., ticker VTRS. This is a stock that I've held for a little while. I believe they were a branch off of Pfizer. So Pfizer branched off their generics section of the company and created Viatris, the company. And I've been holding it since. I grew my position for a little while because I thought that it was undervalued, or at least I had heard in the dividend community that it was undervalued. But today we're going to look into the numbers and see if I was just blindly following the crowd and if I decide that I want to hold this stock or not. So there's not a whole lot going on with the chart. I mean, if we zoom out to the 5-year, this is one of the most depressing and flat charts that I've ever seen. It just drops down, stays steady, drops down, stays steady, and it's just continued that since late 2018, 2019. So we really need to zoom in on the last 2 years to see anything that's going on. And there's no uptrend anywhere to be seen. We do see a downtrend going from February 2022, touched again recently, February 2023, and we're pretty far away from that right now. We're actually sitting right about that support at the $9.25 level, and then we've seemed to have some pretty good resistance at the $12.20 level, and it's been trading in that range for a little over the last year. So this is looking like a dividend stock to me, potentially a trap or a value trap, but we'll have to look into the actual numbers to see if that's the case. And here we have those numbers. So there's not a whole lot of red flags that we see. And we can tell that 2021 was an exceptionally bad year and a big outlier here. So I'm going to do what I can to not let 2021 really tarnish my view of the company and see if they're on a better trend since then. Because it could be a good deal if the market punished them for their 2021 results, but they're right back on track in 2022 where they should have been. We'll see if that's the case. So starting at the top, we see decent compound annual growth rate on the revenue, 12.24%, above 10. That is nice. The cost of goods is only up 8.7, lower than the top line revenue. That is a good thing to see. Gross profit is climbing, 18.57%. That is very good. Net income. They did not have much net income back in 2019. They ended up with a decent amount in 2020. So we see this massive growth number. They were negative in 2021. So there's not anything that we can really draw on from all of this aside from the net income percentage, which is currently at 12.78%, which is not bad, especially with a gross profit percentage of nearly 40%. Then we have their expenses. Their expenses are climbing 10.57% year over year. That is below the top line revenue. Their EBIT is climbing quickly, but that's another case, just like the net income, where there's not a whole lot we can draw from. They operated at a loss in 2021 and are pretty well on track in 2022. Now for earnings, I found conflicting numbers everywhere. I'm seeing that analysts are expecting $2.91 for earnings this year. The same place that says that their expected earnings this year are $2.91 says that last year they came in at $3.34. So we will use that, and that will give us a PE of 3.3% last year and a current PE of nearly 3%. So the market is not expecting a whole lot of growth from this company. I mean, we see a drop from 3.34 to 2.91. That means earnings are declining, so it is not a surprise that there is such a low PE ratio. I mean, if we were to go with the standard 20, we'd be looking at a $50 to $60 price. I don't think that's going to happen. We might even be lucky and see a 10, maybe even a 5. A 5 would be a $16 stock. That'd be much more fair and reasonable. $15 to $16 by the earnings metric. Assets, we see asset growth of almost 7% year over year. Liability growth of 14.33. The book value is negative across the board. We are seeing that it is 2021 was awful. It is on the right track, not from the 2019 level, but up from 2021. So we cannot get a valuation off of a negative book value. This is looking like some of the other dividend stocks that we've looked at, where they're strong on cash flow, they're strong on dividend, they're okay on earnings, but the book value, you as a shareholder aren't really owning much. Honestly, you're not owning anything. You're owning debt. Free cash flows, we see growing 34%. A small increase this last year. So it does seem to have flattened out. Huge jump from 2019 to the 2020s. The share count is growing at a very fast pace, almost 33%. We see it has gone from 516 to 1,213. So it's more than doubled in the same time that the share price has been cut in more than half. So your position's getting diluted at the same time as the value is being eaten away. And that's why we've seen the stock go from almost 20 down to less than $10. Shareholders' equity has grown up about 21% year over year. And then the dividend, they didn't pay one back in 2019, 44 cents in 2021, 48 cents in 2022. So right now it's trading nearly a 5% dividend yield. And historically, this dividend yield has been around this range. At the end of last year, it was 4.3%. So that valued the stock somewhere around 20. I always thought that this stock was somewhere around $20, but it did not hold that value. And now that I've looked into these numbers, I see that had I known what I know now, I would have never even bought this in the first place. I would have just sold once I got the shares from the Pfizer branch off. But let's look at the earnings. Let's see if they are planning on fixing anything or if we're just seeing more decline and it's time to take the losses and find another. We're going to hop straight into the financial summary with this one. So we see net sales decline 11%, not what we want to see. Developing markets down 12, emerging markets down 9, JAN's down 19, and Greater China held steady, even with the lockdowns. Net sales by product category, nothing is up. Complete GX just decimated, down 65%. Gross profit down 13%. Adjusted gross profit down 10%. There is nothing pretty that I'm seeing here. Net earnings down 44%. Adjusted net earnings down 17%. But they beat expectations and the stock is up about 6% since they reported. Capital expenditures up down 26%. That is something that we like to see. Even their cash flow is down 15%. Free cash flow down 14%. Not something that we like to see. Here is their guidance for the year. We see that they're expecting total revenues to be between 15.5 and 16. Last year they came in at 16.3, so that is a decline. Adjusted EBITDA from 5 to 5.4. Free cash flow, they're expecting 2.3 to 2.7, and last year they came in at 2.5. So that's in line, if not some growth expected. This will be a pretty quick company to go through. Again, they don't give you the percentages. Like I said in one of my past videos, That just means that they're trying to hide stuff. We're just going to look at the fact if it's up or down. Net sales down quite a bit. Other revenues down, which of course makes total revenue down. Cost of sales down as we would hope, but honestly not a whole lot in comparison to the net sales. Gross profit is down. R&D, they're spending more on R&D, spending more on general and administrative costs, less on litigation, for a total operating expense up slightly from last year. They come down to a net earnings almost half of where they came in at last year. Earnings attributable to shareholders went from 33 cents to 19 cents. Shares outstanding. Looks like they finally started cutting down their share count, going from 1,210 to 1,202. So not a huge decline, but that will boost the shares value. Assets, we see a decline in assets, and liabilities, we see a decline there as well. Here's a look at sales by product. We could dive deep into this and see. It looks like Lipitor is the top earner here, and it is down. Are any of these up? Looks like Celebrix is up a bit, and they seem to be the only one who saw any sort of increase. Apparently, Viagra can't keep it up. Oh, they did see an increase in EpiPens as well, looks like. And that's all the important stuff for us to look at. My thoughts on this company, I'm going to give it a sell rating. I'm not sure that I'm even going to hold on to the shares that I hold because they're expecting decline this year. Almost none of their product lines saw growth. Only 2 of everything that they show right here. It looks like they're going to be able to increase cash flow, but as they grow as a company, their expenses are increasing, and if those revenues don't increase, if they can't grow their revenues and their earnings per share, then they cannot bring more value to you as a shareholder. And the fact that the book value is negative means all that you're owning right now is debt. So I don't see a reason to be holding this stock. I am probably going to sell out. If anything, it would be strictly a dividend turnaround play. They do have decent cash flows and a decent dividend, which they seem to plan to grow over time at 9% this last year. So they may grow it somewhere from 5 to 10% this year. So if any reason, hold it for that. I feel like if there is value in it, there's a potential in the earnings and the cash flows for the stock to hit $15 a share, but they'd really have to turn things around there. And I'm not sure that I'm going to waste the time waiting for them to turn it all around. And with that, I want to say thank you guys for watching. Please comment who else you'd like me to look at. I believe tomorrow is going to be VST, which will be exciting. That's one of the positions that I'm up massively on. So I get to see if it's time to sell out or if I'm going to keep riding it out.